$39 trillion. That is not a number. That is a countdown. Somewhere inside the United States Treasury, a calculation is being made right now that no press conference will ever announce and no politician will ever admit out loud. Because the debt is not the danger. The interest is. And when that interest bill crosses a line that history has crossed only once before, in the 1940s, there's only one tool left to stop it: printing money. Right now, while you watch this, gold is already reacting, quietly, patiently, sitting at $4,000 an ounce like it knows something the stock market has not figured out yet. The central banks already know. The bond market already knows. The only question left is whether you will know in time. Before we go further into this crisis, let's pause for just a moment. If you're joining us for the first time, welcome to Stick Zennn. Now, I want to ask you something, and I want you to really think about it before you answer. You know how, back in the day when something truly mattered, you didn't just hear about it once and move on? You made sure you'd be there next time too. You made a habit of it, a small commitment that paid off again and again. That is exactly what the subscribe button is. It is not a favor to us. It is a promise to yourself that the next time a crisis like this is unfolding, you will not find out about it too late. So if what you're about to hear matters to you, go ahead and tap that subscribe button now. It costs you nothing. It takes 2 seconds, and it means you will be standing here with us for whatever comes next. Before we begin, I would love to know, where in the world are you watching this from today? Drop your city or your country in the comments below. Let's see just how far this warning is traveling. Now, let's get into it. In the quiet halls of the United States Treasury, numbers are being calculated that most people will never see, and fewer still will ever understand. But those numbers are about to change everything. The United States government now owes $39 trillion. That number is so large that the human mind struggles to hold it. It is larger than the entire economy of China. It is larger than the combined economies of Japan, Germany, and the United Kingdom put together. But the debt itself is not the real story. The real story is the interest. Every single year, the government must pay interest on that debt, the same way a person pays interest on a credit card or a business loan. And for decades, that interest was cheap. Rates stayed low. Borrowing felt almost free. That era is over. The Congressional Budget Office, the official body that tracks government spending, has projected that interest payments alone will reach $1 trillion this year. Not on schools, not on hospitals, not on roads or the military, just on interest, the cost of borrowing money that has already been spent. And the path forward looks even steeper. By the year 2036, that number is expected to climb past $2 trillion every single year. Let that settle for a moment. This is not a warning about the distant future. This is happening now, in real time, while most people are focused on other things. The average interest rate on the total debt currently sits near 3.4%. That sounds small. It sounds manageable. But here's what most people do not realize. If that average rate rises by just 1 percentage point, one single point, the government's yearly interest bill increases by roughly $400 billion. That is not a guess. That is not a prediction from some analyst on television. That is simple arithmetic. And arithmetic does not care about elections. It does not care about political promises. It does not wait for anyone to be ready. Right now, interest payments already consume 19% of all federal revenue. That is the highest share since the years following World War II. 19 cents of every tax dollar collected goes not toward building anything, not toward helping anyone, but simply toward paying for debt that already exists. This creates a trap. A government facing rising interest costs has only a few real choices. It can cut spending sharply, which is politically difficult and slow. It can raise taxes significantly, which is equally difficult. Or it can find another way to make the payments, a way that history has seen before. In the 1940s, the United States faced a debt burden similar to today's. And the solution back then was not spending cuts. It was not new taxes. It was something called yield curve control, a method where the central bank steps in and buys government bonds, keeping interest rates artificially low. In simple terms, it means creating new money to make the payments easier. That solution worked in a narrow sense, but it came with a cost. It slowly eroded the value of the dollar itself. And this is where the story turns. Because if history is about to repeat itself, then somewhere out there, an asset is already sensing it. An asset that has protected wealth through every currency collapse in recorded history. An asset that does not care what any government promises, because it answers to no government at all. That asset is gold. And what gold has been quietly doing over the past few months is not random. It is a signal. Far away from the noise of daily headlines, in a market that most ordinary people never watch, a quiet verdict is already being delivered. It comes from the bond market, and the bond market rarely lies. For years, investors who lend money to the United States government did so at very low interest rates. They trusted that inflation would stay controlled, that the dollar would remain strong, and that lending to the world's largest economy was close to risk-free. That trust is now being tested. In recent months, something unusual happened. The yield on the 30-year Treasury bond, the interest rate the government must pay to borrow money for 3 decades, pushed above 5%. On a weekly closing basis, that is its highest level in nearly 20 years. At the same time, the 10-year yield and the 2-year yield also climbed to fresh highs. To someone outside the world of finance, this might sound like just another economic detail, but to those who study markets closely, it is something far more serious. It means the people lending money to the United States government are demanding to be paid more because they see more risk. They are not panicking. They are not selling everything and running, but they are sending a message quietly through the price they demand. And that message is this: the era of cheap borrowing is not coming back anytime soon. This matters enormously because higher yields mean higher costs. Every time the government needs to refinance old debt or borrow new money, it must now pay a steeper price. And with $39 trillion in outstanding debt, even a small rise in rates creates a massive increase in what must be paid back. This is where history offers a warning worth remembering. In the 1940s, the United States faced a similar situation. Debt levels, relative to the size of the economy, were dangerously high, largely due to the cost of fighting a world war. Interest rates were rising, and the government faced a choice. It could let rates rise freely, risking a slow collapse of its finances, or it could intervene. It chose to intervene. The method it used is known today as yield curve control. In simple terms, the central bank stepped into the bond market and began buying large amounts of government debt. This kept interest rates artificially low, even when market forces wanted to push them higher. It worked, in the sense that the government avoided a fiscal breakdown. But there was a hidden cost. To buy all those bonds, new money had to be created. And when new money enters an economy faster than real goods and services are produced, the value of that money slowly declines. That is the historical playbook. And many serious analysts now believe the United States may be approaching a similar decision point once again. If interest costs continue rising the way current projections suggest, a moment may come when political leaders face an uncomfortable choice. Either allow interest rates to keep climbing, risking a genuine fiscal crisis, or ask the central bank to step in once more, buying bonds and creating money to hold rates down artificially. This is not a conspiracy theory. It is not fear-based speculation. It is a pattern that has happened before under similar fiscal pressure, and one that many economists consider the most probable outcome if current trends continue unchecked. And here is the part that should matter most to anyone thinking seriously about protecting their wealth. If money is created on a large scale to manage government debt, the value of that currency does not remain the same. Historically, it declines, sometimes slowly, sometimes sharply, but it declines, which raises an important question for every business, owner, investor, and entrepreneur watching this unfold. If the currency itself may be quietly weakened in the years ahead, where does real, lasting value get stored? The bond market has already delivered its verdict on risk. Now it is time to look at what the gold market has been quietly telling us in response. Because while yields have been climbing, gold has been doing something that, historically, has only happened right before major turning points. While the bond market delivers its verdict through rising yields, something else has been happening in a much older market, one that has outlived every currency, every empire, and every government that has ever tried to control it. Gold has been standing still, not falling, not collapsing, just holding its ground quietly near $4,000 an ounce. At first glance, this might not seem remarkable, but to anyone who understands how gold typically behaves, this stillness is one of the most important signals in the entire story. Here is why. In a normal market, when interest rates rise, gold usually falls. This is basic financial logic. Gold pays no interest. It produces no income. So when bonds start offering higher returns, investors are usually tempted to sell their gold and buy bonds instead, chasing the better yield. That is the textbook relationship. Rates go up, gold goes down. But that is not what has been happening. Even as Treasury yields pushed to their highest levels in nearly 2 decades, gold refused to break down. It held its position. It did not confirm the pattern that textbook logic predicted. This kind of divergence, where an asset does not behave the way it is supposed to, is exactly what serious market analysts pay closest attention to, because history shows that gold has a habit of moving first and explaining itself later. To understand this pattern more clearly, it helps to look backward. In 1972, shortly after the collapse of the Bretton Woods system, gold experienced its first major modern breakout. What followed was a painful correction, one that convinced many investors the rally was finished. It was not. Gold went on to reach far higher levels in the years that followed. A similar pattern appeared again in 2005. Gold broke out, then entered a period of consolidation that felt, to those living through it, like the end of the story. It was not the end. It was a pause before the next major advance. Today's price action, many analysts argue, resembles both of those earlier periods, not identically, because markets never repeat exactly, but closely enough that the current period around $4,000 looks less like an ending and more like a pause before the next move. There is more evidence supporting this idea, and it comes from an unusual place: sentiment surveys. A recent survey of major fund managers recorded one of the most pessimistic readings on gold seen in 3.5 years. That might sound like bad news, but in markets, extreme pessimism often arrives right before a turning point, not after one. When most professional investors have already given up on an asset, there are simply fewer people left to sell it. Supporting data from options markets and independent research groups showed similarly depressed sentiment levels. Historically, these exact conditions have appeared just before major bottoms in the years 2015, 2018, and 2022. Even within the gold mining industry itself, the signals point in the same direction. At one point recently, only about 11% of major gold mining stocks were trading above their long-term average price, a level historically associated with market bottoms rather than market collapses. None of this guarantees an immediate turnaround. Markets rarely move in straight lines, and further short-term declines remain possible. But when price action, historical pattern, and sentiment data all point in the same direction at the same time, it becomes difficult to dismiss as coincidence. Gold, it seems, may already be sensing what the fiscal arithmetic discussed earlier is quietly building toward. But price charts and sentiment surveys tell only part of the story. The most convincing evidence does not come from traders or analysts at all. It comes from an entirely different group. One that does not speculate, does not panic, and does not act on emotion. It comes from the world's central banks, and what they have been doing with their own reserves over the past few years may be the clearest signal of all. If gold's price action raises questions, the actions of the world's central banks answer them. These are not speculators. They are not day traders chasing quick profits. Central banks manage the reserves of entire nations, and they typically move with extreme caution, planning years, sometimes decades ahead. When they act with unusual conviction, it is worth paying close attention. And right now, they are acting with unusual conviction. Each year, the World Gold Council conducts a survey asking central bank reserve managers, the people directly responsible for a nation's financial reserves, how they view gold. This year's survey drew responses from 76 central banks, the largest number in the survey's history. The answers were striking. A record 45% said they expect to add more gold to their own reserves within the next 12 months. 89% believe that global central bank gold holdings will continue rising over that same period. And when asked to look 5 years into the future, 84% said gold will make up a larger share of global reserves by then. This was not a fringe opinion. It was close to unanimous agreement among the very institutions responsible for protecting national wealth. And the numbers back up what they are saying. In just the first quarter of this year, central banks added 244 tons of gold to their reserves, an increase of 17% compared to the previous quarter. The buyers were not limited to one region. Poland, China, Kazakhstan, Brazil, and others were all accumulating gold at the same time independently for reasons that appear increasingly connected. So what changed? Why are so many nations all at once choosing to hold more gold? The answer traces back to a single event in 2022. When Russian foreign exchange reserves, worth approximately $300 billion, were frozen by Western governments, it sent a message to every other nation watching. Money held in foreign banks, in foreign currencies, could be restricted or frozen entirely, based on political decisions made by other governments. For decades, many nations assumed their reserves were simply safe, sitting quietly in foreign accounts, earning modest returns. That assumption no longer holds. Gold offers something fundamentally different. It can be stored within a nation's own borders, under its own control. It carries no counterparty risk, meaning there is no other institution that could refuse to honor it, freeze it, or restrict access to it. It cannot be sanctioned. It cannot be blocked by a foreign government's decision. In a world where financial systems are increasingly intertwined with political conflict, that kind of independence has become extremely valuable. This shift is also visible in a slower, longer-term trend. As of the most recent data, the US dollar accounts for around 42% of global reserves. It remains the dominant currency, but that share has been steadily declining for years, as more nations diversify into other assets, gold prominent among them. Compared to earlier decades when gold made up a much larger share of global reserves, today's holdings still remain relatively modest by historical standards, which means, according to many analysts, that this accumulation trend may still be in its early stages, not its final one. Central banks are not reacting to short-term headlines. They are not trying to profit from a quick trade. They are positioning themselves for a possible restructuring of the global financial system over the next decade or more, and they clearly believe gold will play a central role in whatever comes next. This raises an important question, one worth sitting with carefully. If the institutions responsible for managing the wealth of entire nations, the most cautious, most risk-averse participants in the entire financial system, are systematically moving toward gold, what does that suggest about the risks they see ahead? They're not making public predictions. They rarely explain their reasoning openly. But their actions speak with a clarity that words often cannot match. The fiscal arithmetic points toward rising debt and rising interest costs. The bond market has already responded with historically elevated yields. Gold's price behavior suggests it may be anticipating what comes next. And now, the world's central banks, quietly and steadily, are confirming that same conclusion with their own reserves. 4 separate signals, 4 different sources, all pointing in the same direction. The only question left is what this convergence means for those who are still watching from the sidelines, waiting for a clearer sign before making a decision of their own.